Hello and welcome back to Econ Unlocked. In our last video, we talked about inflation and how it makes your money worth less. But there's a powerful tool central banks use to fight inflation, and it affects your life more than you might think: interest rates. You've probably heard the news talk about the Federal Reserve raising or lowering rates. But what does that actually mean for you? For your home loan, your credit card, or your savings account? Today, we're going to unlock the mystery of interest rates. We'll explore who sets them, why they change, and how they directly impact your daily financial life. First, let's get a simple definition. What is an interest rate? It's basically the price of money. When you borrow money, you pay a fee for using it. That fee is the interest rate. Think of your home mortgage or a car loan, and when you save money, the bank pays you a fee for holding your money. That's the interest you earn on your savings account. So, for borrowers, a higher interest rate means a more expensive loan. For savers, a higher interest rate means more money in your pocket. The key here is to remember that interest rates are the cost of borrowing and the reward for saving. So, who is the master puppeteer pulling these strings? In the United States, that's the Federal Reserve, or the Fed. The Fed's main job is to keep the economy stable. It has two primary goals: keep prices stable, low inflation, and maximize employment. To achieve these goals, it uses a tool called monetary policy, and its most famous lever is the federal funds rate. When inflation is too high, the Fed raises this rate. This makes it more expensive for banks to borrow from each other, and those costs are passed on to you. It's a way to slow down the economy by making borrowing and spending more expensive. When the economy is weak, the Fed lowers the rate to encourage people and businesses to borrow and spend. Now for the part that matters most. How does this all affect you? 1. Your loans. When the Fed raises rates, loans become more expensive. If you have a variable rate loan like a credit card or some mortgages, your monthly payments will likely go up. If you're planning to buy a house, a small increase in the mortgage rate can mean thousands of dollars in extra costs over the life of your loan. 2. Your savings. The good news for savers is that when rates go up, your savings account becomes more powerful. The interest you earn on your savings and CDs will increase, helping your money grow faster. In a high-rate environment, saving money becomes a more attractive option. 3. The stock market. Higher rates can make the stock market less attractive. Companies may borrow less to grow, and investors might shift their money from stocks to safer, higher-earning savings accounts. This can lead to a cooling or even a dip in the market. So what should you do when rates are high or low? Understanding the direction of interest rates is key to making smart financial decisions. If rates are low, it might be a good time to consider a home purchase or to refinance a high-interest loan. But if rates are high, it's a great time to focus on paying off debt and maximizing your savings. Interest rates are more than just a number on the news. They're a fundamental part of the economic engine that drives our financial lives. By paying attention to what the Fed is doing and understanding the why behind it, you're not just a passive observer. You're an active participant in your own financial future. Thanks for watching. If you found this video helpful, please subscribe to Econ Unlocked for more clear explanations of complex topics. What other economic terms do you want to unlock next? Let us know in the comments below.